Thanks, PMS Bazaar, for giving us this opportunity. Thanks, everybody, for being here to listen to us. We really appreciate it. What I'm going to do is use my time to kind of take you through our journey at Karma, what we are doing, our views on where the market cycle is currently, and how our portfolios are different. So from Karma Capital's perspective, we have been around for a long time. We've been around since 2005. Not too many people know about us because we were primarily focused for many years on offshore markets. Even today, large part of our money is offshore institutional money. Our domestic business, we're starting to build over the last 2.5 years. We've had about 18 years of track at Karma, 30 years of experience for me and Nikhil. Both of us started almost at the same time in the industry. So as a team, we have about 100 years of experience on the investment management side. We manage about 7,200 crores of assets, as I said, primarily offshore institutional money. From our perspective, we've been running a single strategy for almost 16 years, an all-cap strategy called Karma Wealth Builder. It's only in the last 2 years that we've started to add on 2 more strategies, SMID called Lotus and large cap called Magnolia. We are building track records for that. Again, our DNA comes from the fact that we want to build track record before we go out and market. So from our perspective, these 2 strategies are more building track records. They're managed by 2 of our colleagues. So it's not me or Nikhil who is managing it directly. And also, from our perspective, we run concentrated portfolios, so about 20-25 names, and I will come to that in the presentation. We have a long track record. We've generated 18% compounded for the last 10 years. It is 5% alpha on the Nifty TRI and 3% alpha on the BSE 500 TRI. And from our perspective, our portfolios look different, and I'll come to that in some time. We run highly concentrated portfolios, a high active share, 90%. Top 10 stocks hold almost more than 60% of the portfolio. Low churn. Our average holding period is about 5 years. Once we buy into a name, so it's a low churn portfolio, less than 30% a year. We think independently, and I will come to that in terms of how it matters to us as a team. We are not a star fund manager-based approach. We believe in a team-based approach. We believe the longevity of any investment institution is only dependent on how good the investment team is, not on 1 or 2 individuals. And I think that's what we have tried to build over the last 17, 18 years as a DNA for the firm, is the strength of the investment team. And I think more importantly from our perspective, and I was hearing the previous conversation, is where is the returns coming from? Because returns is one thing. As somebody mentioned, last 3-4 years, everybody has generated returns. Our average market cap, so though we are an all cap, our average market cap is about 1,20,000 crores. This is a weighted average market cap. So our returns are not coming just from very small companies. They are coming from reasonably larger businesses. And I think that's a very important part of what we do, of managing risk. I think that's something that is, again, as a part of the DNA of the firm. This is our philosophy. We are growth at reasonable prices. As the earlier slide mentioned, we are early cycle, and I'll come to early cycle, what we mean. We try and identify companies early in the growth cycle, and if we can do it, we can get them at a reasonable price. We also get time to size our position, so we don't need to go and buy a 6% position day 1. We can take 2-3 quarters, even sometimes more, to build our positions. We are an all-cap strategy, market cap agnostic, index agnostic. And I think thinking independently is very, very critical to what we do. In the previous slide, I mentioned that patience and discipline is very critical, not just from a portfolio perspective, also from building business perspective. We have always been a 100% employee-owned firm, and I think that allows us, being a boutique, to do what we do well and take a very long-term view to both our portfolios and to our business. This is a busy slide. I'm not going to, again, bore you with it. By and large, what the slide does is to cramp all that we talk about in terms of process into a single slide. On the right side, what you see is what we look for in a company. Again, catalyst, market leadership. We look for rate of change, and I'll come to that, capital efficiency, balance sheet efficiency. But I think from our perspective, when companies go through a cycle, when they're coming out of a difficult cycle, many a times, the capital efficiency might not look the best. And it happens to all businesses because all businesses go through cycle. So therefore, for us, for the period that we want to own the business, we want to see an accelerating rate of change. And that accelerating rate of change is something which is very important to what we want to own for the next 2 to 3 years, even sometimes longer. So the rate of change is very critical, and eventually boiling down to high conviction names in the portfolio. Again, high conviction because when we own companies for 5 years, there will be periods, sometimes quarters, sometimes maybe a year or slightly more, when companies don't do well. And your ability to own them during that phase of the market when they don't do well is very, very critical from a longer term return perspective. So we believe everything goes through cycle. And from our perspective, like human beings, all of us, businesses and companies go through cycle. And we really liked the Howard Marks thing in The Most Important Thing, the book he wrote, that everything goes through cycle. And we also believers, the cycles can be of different nature, different types, different tenures, but there is a cycle to everything. There's something that somebody taught me very early and kind of has held true for the 30 years that I've been looking at it and maybe even longer. Typically, this is how cycles behave by and large for businesses. The blue line that you see today, that you see on your left, is the underlying business. The green line is the stock, and the black line is the narrative. What we see time and time again is when the business goes through an inflection point, it is past the inflection point, it has started the acceleration journey, but you still see the narrative being negative. Stock starts to move. That's what we call an opportunity, a window to buy from an early cycle perspective. And of course, the cycle can be, as I said, depending on what business, what kind of companies you want to own, can be 2 years, maybe 5 years, maybe 10 years, maybe even longer. And it keeps on accelerating till a certain point, and then it starts to slow down and it turns. The narrative is always slow to change on the way up and on the way down. So I keep joking that what you get on your WhatsApp, if you're getting it on your WhatsApp, that means you are the last guy in the chain, in the food chain to get it. So keep that in mind when you hear the narrative, because that's the power of narrative. Narrative always kind of comes through. The chatter comes through much later, most of the time. I'm not saying it every single time, but most of the time the chatter comes through much slower. Just to quickly talk about the market environment, we generally don't talk about it, but my colleagues told me that no, we have to talk about it. Just to quickly talk about it, I think the post-COVID, India has decade ahead. That I don't think so any of us have any view on, any different view on it. We believe this is India's decade, if not longer. I think where we differ and where we think is the markets are, is that the cycle that we've seen post-COVID in the last 4 years, to us is clearly maturing. And the next 3 to 5 years might be very different than what you have seen in the last 3 to 4 years. The problem is most people start extrapolating. When something happens for a length of time, the extrapolation starts to happen even for longer periods of time. What we have seen in the last 3-4 years is become so normal now to people. As somebody mentioned, 30% returns has become so normal to people that people are starting to extrapolate. That's the concern that you always have. You start extrapolating. Our view as a cycle is maturing and coming to a point where maybe another cycle will start, but clearly this cycle seems to be aging. We are starting to see some slowdown in the economy. We are hoping that gets reversed. First quarter we saw, I think, one of the slowest volume growths in the industry, and that volume growth continues to be sluggish. From our perspective, our portfolios are different. Our portfolios are different coming from a bottom-up stock picking approach, not because we want to be different. Typically, the companies that we have seen reasonably good growth. Somebody before me was talking about healthcare. Healthcare is our largest holding, and I was very happy when he was explaining healthcare and how healthcare is a reasonably stable business. I think domestic healthcare to us is a very large structural opportunity, and to us is also one of our largest positions in the portfolio. And our portfolios are different. Hopefully, they add value to you as an investor. Is complementary to what you might already have as equity exposure. This is maybe slightly controversial slide, but I just thought because this is what we feel about it. We feel that right now the tail is wagging the dog in the market. It's the narrative which is driving the stock price, not the other way around. It's not the cash flows which are driving. People's focus has shifted from cash flows to narratives. And that's really when, as investors, you need to be even more focused on cash flows. From our perspective, the external environment continues to be challenging. Today, the magic words are AI, order book, semiconductors, energy, and every company wants to get attached to these magic words to their portfolio, and they get re-rated. And that to us is what we call the tail wagging the dog. It's not the cash flows. It's basically the narrative which is driving a lot of the current performance in the market. And to us, that is really a yellow flag in terms of, as investors, we want to be doubly cautious, and we want to double down on being even more focused on cash flows, keeping it simple, finding great ideas and companies with strong cash flows. This is what has happened. So I showed you a chart where the business turns, the price turns, and the narrative turns. This is what we call the tail wagging the dog, where the narrative starts to drive the stock price, and then people are hoping that cash flows will follow. And that to us is really the challenge which the markets are facing today. The tail is wagging the dog from a perspective of the markets. What worked in the markets when India went from $1,000 to $2,200 per capita? Things worked. Something like consumer staples did very well. People had no access to toothpaste. People had no access to soaps. People didn't have access to a lot of stuff. That penetration was the story for a decade in India. The story was private banks gaining market share from public sector banks. A 20-year story in India kind of played out. But what we think is going to happen is the journey from $2,200 to $5,000 will be very, very different. The economy will look very different. India is still largely a personal consumption-driven market, as what we call in technical jargon a PCE, 60% PCE market. And that 60% PCE is not going to change in a hurry anytime soon. A lot of industries are going through transformation. A lot of industries are getting consolidated. Pricing power is getting in the hands of the people who are consolidating the markets. We have seen that in healthcare. It's a slow consolidation. It's not going to be a very rapid consolidation like we saw in telecom or what we saw in airlines or what we are seeing in media now. But it will be a slow consolidation. It's not a business where you can throw money and build business overnight. It's a very, very difficult business to build. On the other hand, there are a lot of businesses which are going through fragmentation, new entrants, new players, disruption in the market, causing loss of pricing power, loss of market status for many of these businesses. And this is, to me, the last slide. This is what shows our portfolio and how we are different. Our largest holding is healthcare, as I mentioned earlier, followed by consumer discretionary. We follow GSIC classification. So companies like auto components get clubbed into consumer discretionary. In financials, we don't have any major banks. Our financials is completely payments business. We believe payments is a structural opportunity in India, just starting out, maybe a multi-decadal opportunity from an investor standpoint. And we own two companies there. We got opportunity to own both of them this year because there was some stress in both these businesses. We don't have any energy, we don't have any IT, we don't have any consumer staples. And as I said, we don't have any large banks. So this is how our portfolios maybe are slightly different than what you would have in many of your existing equity book. As I said, average holding period is about 5 years. On the bottom, there is a chart giving you the info, maybe too much of info on the chart, but basically how our growth and valuation on some of the businesses we own are still reasonable. That's very, very important to what we do. At the end of the day, we are not the guys who take cash calls. So we are generally fully invested, but maybe we have the leeway of having cash between 5 to 10%. So that's really in nutshell about Karma. I have maybe a few slides on some of the examples that we've kind of bought companies that we have bought earlier. Just give you some color. I'm not going to talk in detail about any example, but typically early cycle and acceleration is very simple. Bharti had 1% ROE or maybe negative ROE when we bought it at the peak of the comparative intensity in 2020. It did a 40,000 crore loss. Nobody wanted to own. People thought Jio will kill everything. And in next 2 years, today also it's already the 4th largest market cap company. Our investment is almost 3.5 times what we bought. Therefore, we are again going back. We make money in large companies, not just in small companies. And this is typical early cycle for us. And I can keep going on and on in terms of how we have done for some of our other businesses. But by and large, this kind of covers it. I've come to the end of my time. Thank you so much for your patient listening. And I really appreciate it.